This question is looking at January 2019 question 3, focused particularly on IAS 10 standard events after the reporting period and associated journals. So again, I assume you have read through the question. It's quite a tricky question in this paper in terms of provide the necessary journals for each of the 4 items, so 10 marks. And then for items 1 and 2, they want you to explain, given the rationale, using IAS 10. So your ability to understand what IAS 10 concepts are and how they apply to 1 and 2. So we'll answer A and B together as we come to each one. But again, you're 15 marks, remember, in a 90-minute exam. So you're talking somewhere around 12 or 13 minutes to answer a question like that. So again, you are under a lot of time pressure in the exam, particularly when you have a long question 1 and a decent sized question 2 to get through as well. So we'll take through each one, and remember there are marks going for workings. If you look down the bottom, the examiner tells you your final answer should be written in the answer booklet and all workings should be clearly labelled. So label in working 1, working 2, and typically we give you a pre-formatted booklet for the answer. So the debits and credits go in the pre-formatted table and your workings should be referenced in so the examiner can follow where they're coming from. So we're looking here then at adjustment 1. We're told here on the 1st of January 19, so it's a day after the year end, a fire destroyed with plant carrying value of 140,000, and there will be an insurance policy to cover the fire damage. So at the end of the previous year, they recognised the loss, removed the property, recognised the receivable for the insurance policy, and credit deferred income because they haven't got the insurance policy in yet. Right? So again, the point is here, this is after the year end. This is the start of the next year. So we're trying to figure out what is that under IAS 10. So you should know under IAS 10. So I'm going to pull up the standard here. There's 2 main types of events you can have in IAS 10. This is paragraph 3. You can either have an adjusting event, right? Or you can have a non-adjusting event. Let's see what this highlights. And you can have here a non-adjusting one. So the key point, an adjusting event is that to provide evidence of conditions that existed at the end of the reporting period. So what we mean by that is they were already there at the year end. If that's the case, you have to adjust for that event. However, if it's a non-adjusting, they are indicative conditions that arose after the reporting period. And that is what we have in this one. This was not there on the 31st of December. Now it happens to be 1 day later, but the plant wasn't destroyed by fire at the year end. It happened after the reporting period. So that is what we're calling a non-adjusting event. And the nice thing about this standard is they give you examples. So for adjusting events, you come here, they give you examples in paragraph 9 of all the possible adjusting events you have, and very likely that the examiner will take one of those for your exam. Right? And you should adjust the amounts recognised for adjusting events. However, when we come to non-adjusting events, you shall not adjust for these, you should only disclose them. Right? And the examiner gives you examples down here in paragraph 22. Here's the examples of non-adjusting events. And they say if the non-adjusting event is material, you should disclose it, the nature of the event and the financial effect, but you shouldn't adjust for it. And what you'll notice is paragraph 22, so section D, the destruction of a major production plant by fire after the reporting period, that's a non-adjusting event. Again, if you know your standards, you know the examples, good chance that they'll come up in the exam. So in that case, all of these should be reversed. This should only be disclosed in a note to the account. It shouldn't be adjusted for because it is a non-adjusting event. And that is the kind of language you're looking for in your Part B, is to say it happened after the year end. It is what IAS 10 calls a non-adjusting event. Therefore, it should only be disclosed. So that's worth about 2.5 marks as well. So what you're doing there is you're just reversing everything. Credit insurance expense, credit trade receivables, debit PPE, and debit deferred income. So all it is a complete reversal in terms of the adjustments. And that's your first adjustment done. But again, the examiner is looking for you to be able to articulate why you're doing it, and that's your Part B. So you can answer Part A and Part B together. So no harm to be happy enough for that. Next one then, we also have to give an explanation for this, remember, because they ask it in Part B. Trade receivable, which owed Yelkin 9,000 at the year end, was declared bankrupt on the 8th of January, has no expectation of receiving any money, and they decided to write the net write it off against the general allowance for bad debts. Now typically this is not how we'd record a bad debt unless it was previously provided for. So again, we don't have that here and that information, so we're assuming that is incorrect. And although they were declared bankrupt on the 8th of January, this is a common example in IAS 10 as well. That if we go back up to the examples of adjusting events, what you will see here, the receipt of information after the reporting period indicating that an asset was impaired at the end of the reporting period. For example, bankruptcy of a customer that occurs after the reporting period, i.e. on the 8th of January, which we have, usually confirms the customer was credit impaired at the end of the period. So that's an adjusting event under IAS 10. See paragraph 9, paragraph 10. So what we're saying there is they should be adjusted, but the adjustment was wrong. That should be debit bad debt expense, and it should be credit allowance for bad debts. Now it's just slightly different answer. 9,000, 9,000. So you're saying the adjustment is fine, but it should be adjusting your bad debt expense rather than your allowance for bad debts. And to answer your part B, or part B there, you're going to say this is an adjusting event under IAS 10. So it should be adjusted in the financial statements, because although it happened in the 8th of January, IAS 10 says that gives you an indication that this trade receivable was impaired at the year end as well, because things can change that dramatically over 8 days. Right, so that's your adjustment 2, and that's also part B answered. But you're always referencing back to the key terms in the standards. There's only a certain amount of standards examinable for the January interim assessment, and you need to know those well to be comfortable going in. So adjustment 3 then, on the 4th of January, again after the year end, sale of 200,000 was made to a major customer. They since notified they're unhappy with the goods, and the goods are returned in a full refund, and another customer is willing to take the returned shipment at full price. However, to be prudent at the year end, they've made the following entry: increased their cost of sales and credited a refund payable. Now the key point is here, this is after the year end. Right? The sale and the subsequent sale were after the year end. So none of this happened in 2018, therefore there should be no adjustment in 18. It's not as if the inventory has to be written down, because you know you'll be able to sell this at full price to someone else. So inventory, it's not an indicator of inventory being written down, because you can sell it full to someone else. So this is just a complete unnecessary adjustment, and all you do is reverse it. You're going to debit refund payable, and you're going to credit cost of sales. And that's your adjustment, 200,000, 200,000. You don't need to provide a detailed explanation here because it's not asked in part B, but it's no harm to have an idea of what's going on. You debit your refund payable and your credit cost of sales, because it all happened after the year end. And then finally adjustment 4, which is a tricky one, probably the hardest one. Inventory costing 12,000 was close to its perishable date at the 31st of December. 5 days later you sold it at a 30% discount to its normal selling price. Right? Normally it sells at markup of 40%, and Yelkin made the following entry at the year end. It debited current assets and credited cost of sales. So it recognised inventory at 3.6, right? But you're saying inventory costing 12,000 was close to its perishable date. Now this is a common adjusting event as well. So if you go back, one of the other examples is the sale of inventories after the reporting period may give evidence about their net realisable value at the end of the reporting period. This is what we have here. We're selling the inventory 5 days after at a significant discount. So that should give us an indicator that this is probably need to be written down at the year end. So there's a link here between IAS 2 as well. We are valuing inventory at the lower of cost and net realisable value. So, but we first have to figure out what did they sell it for after the year end. So we know the cost of this is 12,000, and we know the normal selling price is based on a markup of 40%. So normal price here, how you get the normal price is you add on 40% times 1.4. That's what a markup means, it's a markup on cost. The normal selling price is 16.8. They sold it for a 30% discount. So there is a couple of steps, you have to read the question carefully to understand. So they actually sold it for, on the 5th of January, they sold it for 70%. of the normal selling price, which is the 30% discount. So they sold it for 1160, and we give that as an indicator. That's our NRV. So under IAS 10, if you sell inventory just after the year end, that can be an indicator of the net realizable value at the end of the year. And we know here that is an adjusting event under IAS 10. So your net realizable value is 11,760. We know our cost was 12. So under IAS 2, and again I'd write down these to the examiner to show them I know the technical guidance. That means there's going to be a write down of 240. My cost is too big and it should be at the lower of cost in NRV. So I have to bring it down to 11,760. So this 3,600 is completely incorrect. You're going to credit inventory and you're going to debit cost of sales. 36 and 36. And what you want to do instead, so that is the reversal of the incorrect entry by Yelkin. You're going to reduce your closing inventory by 240. Because that is the impairment of inventory at the year end, an adjusting event under IAS 10. How do we reduce inventory? Is you're going to debit cost of sales, 240, lower closing inventory, increases cost of sales. That's why we're debiting it. And you're going to credit inventory as a current asset, which is 240. And they are your two adjustments. That was quite a tricky one in terms of working out the normal selling price first and then working back to the net realizable value at the end of the year. Right, so that was a good question, but you can see here, as well as having basic double entry bookkeeping questions like suspense accounts, like trade receivable or trade payable control accounts and bank reconciliations, you can also just have an individual standard, for example IAS 10. So go back and look at your competency statement, make sure you know exactly which standards are examinable, because you could get a full question on a single standard. So that was the January 2019 paper, question 3 on IAS 10.